Well, thank you for staying tuned. The Central Bank of Nigeria's Monetary Policy Committee has increased the benchmark interest rate by 150 basis points to 26.25% from 24.75%. Governor of the bank, Mr. Olayemi Cardoso, disclosed this at the press briefing following the meeting of the bank. The Apex Bank also retained the cash reserve ratio of deposit money banks at 45% and put the asymmetric corridor around MPR at plus 100 and minus 300 basis points. The bank further set the liquidity ratio of banks at 30%. Let's deliberate more on the outcome of the Monetary Policy Committee meeting. I have the head of research and strategy, Greenwich Merchant Bank, Mr. Olushola Ore Oyeniku. Thank you so much. It's good to have you on the program. It's your first time on the show. Thank you for being here.
Thank you very much for having me on the program.
Yes. First, let's start with your expectations before this meeting. Did you project that there was likely to be any hike, considering what was on ground?
Yes, increase was absolutely anticipated. We spoke extensively about this during our various engagements before the MPC meeting. Recently, the leadership of the Monetary Authority has continued to emphasize that its consideration is to focus on the current inflationary pressure, that is the need to anchor inflation expectations, and secondly, to ensure sustainable exchange rate stability. So, riding on the back of this and taking into consideration the April inflation figure as released by National Bureau of Statistics, that indicated that though marginally, inflation increased by 0.4%, 49% to 33.7%. So our guidance on this further tightening was primarily on the expectation of higher inflationary pressure emanating from the currency depreciation that we saw across the months, 2 months, and also the anticipated impacts of the potential review of the minimum wage by the federal government. So reasonably, we anticipated that the committee would continue to rein in on inflation. To put this in context, the benchmark interest rate has been increased by about 750 basis points during the last 3 policy committees thus far this year. So that was anticipated, and we had extensive discussion around that discussions before the meeting.
To decline, I think you also alluded to that in inflation figures month on month, actually. But mine would be, do you think that the Apex Bank is starting to get things right? Are we on the right track to recovery?
Okay, so it is appropriate to mention at this point that in the last 2 months, the economy has recorded a traction of improvement in inflation rates. Yes, marginal increase in April. If permitted as a measure, that shows that things are beginning to be in shape at the right direction. If we use comparative numbers, you agree with me that inflationary pressure has slowed down considerably, giving the 0.4% year-on-year increase to 33.7% in April. Compared to where we're coming from, remember we had a 1.5% increase in March. So that's if we use that as a benchmark or as a lead for our analysis, it shows that things are beginning to move in the right direction. Hence, I believe that if you are to tick the boxes in line with the MPC's consideration of commitment to price stability mandate, then that should be in near green territory, and that simply shows that the set target, they are moving in the right direction. Although the drivers of inflation will be a total different discussion altogether, but if we just take it as an absolute number, absolute figure, then I believe that has resulted into primarily what they want, and I think the focus is still on driving down inflation with higher interest rates.
The bank's tight monetary policy is something that operators react to, particularly in the real sector. They say it's killing businesses, lending costs and all of that. Can you help us to understand the implications of high MPR on the entire business community?
So, as expected, one of the potential downrisk of tight monetary condition is possible slowdown in growth. But in the short term, as that will impact on business environment, attendant implication on household and also productivity. So the emphasis on the fiscal authorities complementing what the monetary authority is doing is very important in order to boost productivity and employment. So, in this respect, I believe it is obvious that the leadership of both monetary and fiscal authorities in Nigeria, they are well abreast of the interdependence and relationship between those two authorities or two policies. And as such, both have been working hand in hand, and effective collaboration we've seen to ensure that there is sustainable development. Of particular note is the fact that they are working together to produce commendable results towards achieving the federal government's long-term economic growth. Yes, we're also optimistic that with the current measures and those intended things that they had planned from some of the notes we've seen, we believe that that will lead to price stability and also provide a basis for sustainable economic recovery. So for business, for the equities market, we believe that increase in the minimum cost of borrowing will lead to slowdown for corporates and potentially lead to weaker sentiment for the stock market. So for context, you remember that in March, the MPC, before the MPC meeting, so we check about what has happened. The domestic investors, they started realigning their portfolios from there to take advantage of the high interest rate environment. And as such, it's evident in what the NGI ASI returns are doing year to date. It has lost about 7.6% from that meeting, the last meeting in March to now, about 31.4% now. As at March, it was about 39%. So as expected, we believe investors will keep trading this pattern, and then this will provide direction in order for them to be cautious because the weaker appetite for equities will keep kicking in. So on the flip side, for the fixed income, we believe this will stimulate activities in the fixed income market. Yes, there will be new securities to be issued according to the DMO timetable. So we believe these new issues or these new bonds will be issued at higher yield to reflect the increase in interest rates. So bonds with long duration, we believe they are very sensitive to interest rate, like you know, and as such, we experience substantial price changes in those compared to the short-term bonds. So we believe this will continue to play out for investors or for businesses around the economy.
You've touched on my next question because I wanted to also talk about the fiscal side and, of course, the monetary side, that synergy that we always talk about most times. But the reaction, what will be your reaction to the external economy? There are other issues surrounding the external economy and that would definitely affect expected figures like inflation, GDP growth, and all of that. Do you think that we are addressing many of these heads on? For example, the fallout of subsidy removal. Many say the government is still grappling with that. Minimum wage is also there. Government is here. Labor is there. What do you think and what effect will all of these have moving forward?
Yes, so you're right. Our present economic challenges are hydra-headed, if I may call it that way. And that's, like requires intentional and deliberate action and the will to implement targetable, viable policies. We've seen this so far, various policies implemented in the past 1 year by the current government. However, we believe that federal government will keep consolidating its efforts in order to achieve sustainable results. That is, things they've done now, they will keep consolidating on that, keep providing policies. And once that is in place, we believe that we'll continue to see a trajectory in results. Knowing fully that some of these challenges are not things that we can just get in and kick out immediately. So we believe that various policies actions needed to urgently achieve price stability, growth, and also support the local currency from the physical side and the monetary side will continue to be complemented. And as such, we expect that this will be top priority, knowing fully well that the increase in interest rates, we've had a series of this in 2022, and from experience, it wasn't really providing. It didn't really provide the needed results. But then, yes, we are achieving that now because the fiscal policy fiscal authorities also are kicking in several policies that is complementing what the monetary authorities are doing. So, to mention but few initiatives that's for growth and stability, we've seen what has happened. The deliberate focus on security that has at least a bit improve our oil production in April. But then the long run attendant of that, the sustainability of that, will really impact on our fiscal revenue. Yes, what our production levels is not up to what OPEC production that is, or probably our 2024 budget benchmark. But then we believe that if this deliberate focus or effort is ongoing, we might not hit the bullseye by say December, but then we know that at least there's a +5 -5 in terms of what we can do, what we've been doing. So also we also seen where federal government providing support and security for farmers. That is to ensure increase in production and also food security. So we believe that this, if it continues, the trajectory is taken in and continue the way it is now, we believe that we will achieve sustainable results. So government, we believe, are focusing on these things. Border reopening too, we've seen what has happened after the Nigeria axis was open. So we believe government are also quickly thinking about also the consideration in terms of the other borders. So for infrastructure deficit, all this, the efforts at reducing all this in terms of improving electricity supply, providing motorable roads in the rural area in order for agri-produce to be able to be taken at a cheaper cost. Food storage and processing capabilities, we know what has happened in terms of how government have continued to provide funding for that. The robustness of this measure, we believe, would provide increased reliability and provide sustainable results across the critical sector of the economy. But one thing that we are more concerned about is for the sustained level of the focus on those policies to be maintained and as such so that in the long run, the results, desired results will be achieved, and then the populace would also benefit from that briefly.
Well, it's really an interesting conversation, I must say, and I must thank you, Head of Research and Strategy, Greenwich Merchant Bank, Mr. Olushola Ore Oyeniko. Thank you so much for joining the program. I appreciate this. Enjoy the rest of your day.
You're welcome. Thank you so much. Enjoy the rest of it.
All right.